As a value dividend investor, I'm always looking for opportunities to buy companies whose intrinsic value is far higher than their current trading price and who also has a history of increasing in the amount they pay in dividends. So in this video, we are going to be looking at Target stock. We can see Target has been absolutely hammered over the past year. They're currently down about 40%, and year to date, they are down 33.35%. We can see they had a huge sell-off in May where they were trading as high as $220 per share and dropped to as low as about $150 a share within just a few weeks. Now, there's a couple of things that we do need to note about Target stock here. Obviously, like I said, they have a huge history of increasing the amount they pay in dividends, almost 54 years. When we take a glance at their revenue, we can see this is obviously a very sustainable dividend. They have dramatically been increasing the amount they bring in revenue from 2014 to 2022, and I don't see that changing in the near future. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Target and decide if it's a stock we should be buying or selling. It's always important to remember, just because a stock price goes down does not necessarily mean it's a buying opportunity. We want to make sure that the intrinsic value of the stock is much higher than the current trading price. But on the spreadsheet, we have 4 different valuation models. We have Graham's valuation, we have a discounted cash flow model, a multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So the first thing we're going to do is we're going to come up here and we're going to plug in Target stock ticker and hit enter. And you can see once I hit enter, all this data is going to automatically load in. So we're currently looking at a 365-day change. So we can see a drastic drop in the share price just as we looked at a moment ago. Now they're currently paying out $4.32 per share, which gives it a dividend yield of about 2.8%. Now the payout ratio is just sitting at 27.8%. So obviously this is a very safe dividend, nothing to worry about there. When we take a glance at the moving averages, 20-day moving average actually positive, 50 still slightly negative, and then the 200-day moving average down pretty dramatically at negative 26.85%. Now, something that is worth noting is this is a company that has pretty high institutional ownership at just a little over 80%. Analysts currently have a target price of $186 per share, and then the beta of 1 even, which means that the volatility level of this stock is going to follow the market very, very closely. But let's go ahead and jump into our first valuation model, which is going to be Graham's valuation. This is a valuation model invented by Benjamin Graham. He's the author of the greatest investing book of all time, The Intelligent Investor, and he's also one of Warren Buffett's closest mentors, and this is the formula he laid out for us to calculate intrinsic value. So the first thing we're going to need is the earnings per share, which for Target is actually pretty high. It's one of the highest they've ever had. And then we're going to multiply that by the price to earnings of a company with no growth, which is 7, and then we apply our growth rate projection after that. Now, analysts are still projecting a pretty high growth rate for Target at 14, and then we multiply that by 4.4, which is the average yield of AAA corporate bonds. Then we're going to divide all of this by Y, which is the current yield of AAA corporate bonds. At the time of this video, that is currently sitting at 4. So when we plug all of this in, you can see we come to an intrinsic value of $278 per share, which is far higher than the current trading price. But that's just one valuation model. Let's go ahead and look at our 3 others as well. The next one we'll look at is our discounted cash flow model. This is one of the most popular ways to value a stock. Essentially what it does is it uses the future free cash flows to predict what the intrinsic value of this company is. So in order to find the future free cash flows, we're going to need to project a growth rate to those future free cash flows. And to do so, what we're going to do is we're going to look at the historical free cash flow for this company and see what the average growth rate for it is. So we can see in this situation, it fluctuates quite a bit, but they did have an average growth rate of about 20% for their free cash flows over the past few years. Now, I don't think it'll be that high moving forward, but when I look at analyst expectations, industry expectations, and just some personal research from me, I think a growth rate of about 12% is going to be pretty close for the future free cash flows for this company. So I used 12%, projected it to the future free cash flows, and also added it to the terminal value, which is the sum of all the future free cash flows past the year 2030. I then found the present value of these future free cash flows and added them together here. I found the company's cash and cash equivalents and subtracted out their total debt to get my equity value. Once I had the equity value, I divided by the number of shares outstanding to come to my discounted cash flow price per share of $257 per share. Again, much higher than the current price. Let's go ahead and jump over to our multiples valuation. The idea behind our multiples valuation is using a multiple such as a price to earnings multiple. We should be able to see how the market is valuing companies that are similar in structure to Target, and then apply that average price to earnings multiple to Target. So for example, we're going to take companies like Walmart, Dollar General, and Kroger. We take their stock price and divide by their earnings per share to find their price to earnings multiple, which we can see right here for each of these companies. We then take the average price to earnings multiple, and we multiply it by target's earnings per share to come to our intrinsic value using the multiples valuation of $255 per share. So again, that is much higher than the current trading price for Target. Now let's go ahead and look at this right here. So we can see again, average price to earnings multiple of 21.2 basically for these companies similar to Target. If we jump back over to our stock screener, scroll down a little bit here, we can see Target currently has a price to earnings of just 12.8. So it's no surprise there that we found that the company is undervalued according to the multiples valuation. But let's go ahead and look at our last valuation model, which is going to be our dividend discount model. And this is going to actually be a pretty important valuation model for me personally, because I do like to see dividend growth and high dividend payouts from any of my investments, obviously. And the idea behind this valuation model is we should be able to value a company based on how much they pay out in dividends and how much that dividend payout is increasing. So what I've done is I've plugged in the quarterly dividend payouts over the past few years so we can see exactly how much they pay out yearly. And this allows me to see year over year how much that dividend payout is increasing. So you can see we had about 3 years where the dividend increases were right at 3%. And then we had a huge jump just a little while ago of a 32% increase in their dividend payout. So that's an average growth rate of about 10.43%. Now that likely won't be sustainable long term, although the company is in very good financial health short term speaking. I think a growth rate of about 6.5% is probably going to be a little more accurate. That's still a really good dividend growth rate. I'm then going to apply a discount rate of about 9%, which gives me a dividend discount model price per share of $153, which is very close to the current trading price for this company. But let's go ahead and jump over to our output tab. And here on the output tab, we're going to be able to see all 4 of our valuation models. Grams at 278, multiples at 255, and then discounted cash flow 257, and then dividend discount model, a little bit of an outlier at 153. But when we average all 4 of these intrinsic value models together, you can see we come to an intrinsic value of $236 per share. Now, the current trading price for this company is $154, but as a value dividend investor, we always want to make safe value investments. And a way we can do that is by applying a margin of safety. This is something that Warren Buffett does, Benjamin Graham does to all of their investments. So for example, let's say we want to apply a 20% margin of safety. When I hit enter here, we can see based upon that, our acceptable buy price for this company is $188 per share. So our valuation spreadsheet is telling us this is a stock we should buy. Now, a lot of people recommend a little bit of a higher margin of safety. So let's say 30%. I'll hit enter, and again, we can see our acceptable buy price is $165 per share. So again, our valuation spreadsheet is telling us this is a stock we should be buying. So again, just because a company's stock price drops pretty dramatically does not necessarily mean it's a buying opportunity. But when I come across a company like this who has really strong earnings per share, it's going to continue to grow their free cash flow and has really good dividend growth, and we can obviously see their intrinsic value is much higher than their current price, I think it could be a phenomenal opportunity to add to your dividend portfolio. But go ahead and let me know what you think of this company in the comments below, if you plan on buying or if you plan on selling it. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. I've also partnered with Seeking Alpha to provide 40% off their premium subscription at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.